Imagine a company right on the edge, just facing total commercial collapse. And then, bam, one huge, audacious move. They dish their entire identity, their whole business plan, and bet the farm on one of the most volatile assets, well, anywhere, really. Is this going to be looked back on as, a stroke of genius, corporate agility redefined, or is it just the final desperate gamble of a company going under? We're talking about Helius Medical Technologies, HSDT, their radical pivot from struggling neurotech, basically becoming a publicly traded crypto treasury focused on Solana and the market. Well, the reaction was absolutely explosive. Stick around, we're diving deep into HSDT's pretty unprecedented transformation. We'll try to uncover the huge opportunities and, the massive risks that lie ahead for you. Welcome to the deep dive.
Today our focus is Helius Medical Technologies, Inc. That's ticker HSDT, and specifically what happened around that key date, September 15th, 2025. We've got a great stack of sources you provided detailing their journey, and our mission today is really to unpack this dramatic strategic shift. We need to look at the legacy business, this audacious new direction.
And pull out the most important bits of knowledge, the insights, so you can really get your head around what is actually unfolding here. Okay, so to really grasp just how big this pivot is, we need to understand what Helius was, what it stood on, or maybe what it crumbled upon. Let's kick off with Chapter 1, Bigness Analysis. So Helius's original thing, its purpose, was neurotechnology, trying to improve neurological function. Their main product was the portable neuromodulation stimulator, the PON-S device. It wasn't an implant or anything. It had like a controller you wear and then a mouthpiece that sits on your tongue. And it delivered this mild electrical stimulation. The idea was to boost neuroplasticity, help patients with neurological issues, especially if they did it alongside physical therapy.
Right. And it wasn't just some pie-in-the-sky idea either. The PON-S device actually hit some pretty significant regulatory milestones. It got authorized in the U.S. specifically for gait deficit in mild to moderate MS patients. And in Canada, it was even broader balance issues from mild traumatic brain injury, gait from MS and stroke. They even snagged FDA breakthrough designation. That's, a pretty clear signal of its potential.
But here's where the story takes a sharp turn. Despite all that promising science, all those regulatory wins, the business model was, well, let's be honest, fundamentally broken.
Yeah.
Helius just could not cross what they call the commercialization chasm. They couldn't sell it. I mean, look at the revenue. Consistently tiny, just $295,000 for the trailing 12 months up to September 2025. And get this, the device itself cost over $28,000 to produce. They struggled massively with getting insurance to pay for it, which, despite some recent progress on that front, ultimately led to an $11.7 million net loss in 2024. And the gross profit margin, a mind-blowing negative 89.2%. They were actually losing huge amounts of money on every single device they managed to sell. The science might have been there, but the market just wasn't. Okay, so that's the backdrop. A failing medical device business. Now let's turn to the new business model. A publicly traded Solana Treasury, September 15th, 2025. Helius drops this bombshell announcement. They're completely transforming, ditching medical devices altogether to become a SOL Treasury company.
Yeah, and this wasn't just, a press release saying we're changing. This pivot was powered by a huge private investment in public equity offering, a PIPE deal. And it was oversubscribed. They raised over $500 million from institutions, but also from crypto-native investors. The deal price was $6,881 per share, and it came with these stapled warrants attached, which, if exercised, could bring in another $750 million down the line. That's an incredible amount of cash flooding into what was basically a near-dead company just hours before.
And what's really fascinating here isn't just the money, it's the structure. It's almost like they're using the traditional finance regulations to offer this crypto-native asset, SOL, but wrapped up in a regular stock ticker.
Yep.
So the strategy now is crystal clear. Take the vast majority of that $500 million plus and use it to buy SOL, the cryptocurrency of the Solana blockchain. And just hold it. That's the company's main asset now.
Exactly.
So HSDT stock effectively becomes a proxy for Solana. If you want SOL exposure, you just buy HSDT shares on NASDAQ. No need for crypto exchanges, wallets, none of that hassle.
And there's a really crucial difference here compared to, say, MicroStrategy buying Bitcoin. SOL is a yield-bearing asset. Solana uses proof of stake, that's its consensus mechanism, which means SOL holders can stake their tokens, lock them up temporarily to help secure the network.
Okay.
And in return, they get rewards. It works out to roughly a 7% annual yield, give or take. So Helius potentially has this income stream coming in beyond just hoping the price of SOL goes up.
Right. And the mechanics of how this all happened. It really points to what's basically a reverse takeover, doesn't it?
Absolutely. These new investors, big names like Pantera Capital, Summer Capital, They weren't interested in the pawn and S device at all. They were essentially buying HSDT for its NASDAQ listing. That's the shell. They inject $500 million into this tiny company. Its market cap was only around $8 million before the deal. And boom, they bypass the whole traditional IPO process. It's a shortcut to the public markets for crypto-focused capital.
So this pivot didn't just change Helius's product, it totally changed their playing field.
Yeah.
Let's dig into the industry analysis. Red ocean to blue ocean. What was that old competitive space like for Helius?
Well, they were in the neurorehabilitation devices market, which is, a decent-sized growing market, expected to get much bigger by 2032. But, and this is the key thing, it's a highly competitive space, a real red ocean, full of sharks. You've got giants in there like Medtronic, Abbott Labs, Boston Scientific. For a small company like Helius, it was just an incredibly tough fight, and frankly, one they were losing badly.
Okay, so that was the red ocean. What about this new ocean?
Right. Now they've jumped into the nascent and dynamic digital asset treasury industry. And their chosen asset, Solana, it only launched in 2020. It's known as a high-performance Layer 1 blockchain. Super fast transactions, low costs. It's become a really significant hub for decentralized applications, dApps, things like DeFi, that's decentralized finance, NFTs, gaming metaverses. It's a very vibrant, fast-moving ecosystem.
So the pivot is framed as this strategic leap from the bloody red ocean to a potentially wide-open blue ocean.
Exactly. But, and this is crucial, this new blue ocean, while it has huge potential, it comes with its own serious dangers. We're talking extreme volatility, a really uncertain regulatory landscape, and totally new kinds of technological risks. They've basically swapped the near certainty of a slow failure for a high-risk, potentially high-reward bet on something completely different.
And that switch also means their competitive advantage. A new moat looks completely different now. With the Pawn S device, brand recognition was, well, minimal, right?
Pretty much non-existent, yeah. But now, the Helius name, HSDT, it's going to be inextricably linked with these huge, powerful backers, Pantera Capital, Summer Capital. That gives them instant credibility, especially within the digital asset world.
And cost advantages. The old business clearly had none. Those negative gross margins tell that story.
Right. The new model, though, its success depends on being lean. A really lean corporate structure. They need to minimize those wrapper costs, the overhead of running the public company, so that the stock price can track the value of the underlying SOL as closely as possible.
What about network effects? Pawn and S didn't have any, really.
No. But the new HSDT could benefit here. If it becomes the sort of default choice for institutions or even retail investors who want SOL exposure through traditional markets, then it could attract more capital, more trading volume. That creates its own kind of momentum, its own network effect for this specific type of crypto access.
And their unique assets. Totally transformed.
Completely. Before, it was the intellectual property, the patents for the 1S device.
No.
Now, it's the NASDAQ listing itself. That's incredibly valuable. It's the $500 million in new capital. And critically, it's the expertise of this new leadership team. They bring deep knowledge of both crypto-native investing and traditional capital markets. That combination is the new unique asset.
Okay, that makes sense. Let's shift gears now and focus on Chapter 2. Management evaluation.
Yeah.
Because this is really a tale of two completely different leadership teams.
Yeah, absolutely. The legacy management, led by Dane Andriff, well, their tenure was marked by just a persistent failure to actually commercialize the Pawn S device. The stock performance was catastrophic. They had to do multiple reverse stock splits just to keep the NASDAQ listing. And their main strategy for dealing with the cash burn was just repeated dilutive capital raises, which, hammered existing shareholders. Honestly, the pivot itself was basically an admission that the original strategy just hadn't worked at all.
But now, we're looking at a completely fresh slate, an entirely new, highly specialized team. Tell us about Joseph Chi, the incoming executive chairman.
Right. So Joseph Chi, he's the founder and chairman of Summer Capital, one of the lead investors. But crucially, his background includes being the former head of investment banking for Asia at UBS. That's top-tier traditional finance experience. That kind of background is, frankly, perfect for navigating the complex capital market strategies often involved in these digital asset treasury plays.
So this isn't just shuffling the deck chairs.
Not at all. It's really an acquisition of a very specific high-level skill set needed to build this completely new business from the ground up.
And then you have Pantera Capital involved. What role do they play?
Pantera Capital is huge in the crypto space. They're coming in as a board observer and strategic advisor. You've got Cosmo Zhang, a general partner, and Dan Moorhead, the founder. Cantera is one of the oldest, most respected institutional asset managers focusing purely on blockchain and crypto. Their involvement brings immense credibility, strategic insight, and frankly, an invaluable network within the entire crypto ecosystem.
Okay, what about communication transparency and ethical reputation? Historically, anything major to note with Helius?
Not really. They followed standard public company communication practices, no major ethical scandals that came up in the sources.
And the new team's approach?
Well, there seems to be a new emphasis here. The new management is publicly committing to transparency. They're specifically prioritizing verification of holdings, proving they actually own the SOL they say they do, and strong engagement with the SOL ecosystem and community. That's absolutely critical in the crypto world. Verifiable data, community trust. That's paramount for investor confidence. It's definitely something to watch. Can they maintain that level of openness?
Let's talk capital allocation, an inverted philosophy.
Yeah.
Because this is completely flipped, hasn't it?
Oh, completely. The old Helius was like any typical development stage medtech company. They poured money into R&D for the Pons-S device and into sales, general and admin SG&A, trying to build out a commercial operation. And the result was just continuous, significant cash burn with very little revenue to show for it.
And the new strategy?
It abandons all of that. Their core business now is managing the digital asset treasury. So the primary use, almost the only use of that $500 million plus they just raised, outright purchase of SOL tokens on the open market, full stop. They've also mentioned they intend to explore staking those SOL holdings to get that 7% native yield we talked about.
Right.
And maybe down the line, even more complex activities within DeFi. But the core is buy and hold SOL and stake it. It's a profound shift. They're moving away from trying to create value internally through operations to basically storing value and hoping for appreciation tied to an external, highly volatile asset.
And things like share buybacks or dividends, what's the outlook there?
Well, Helius Medical Technologies never paid a dividend, never did buybacks before, and under this new model, it's extremely unlikely they'll start paying dividends. Any excess returns, any yield they generate from staking, it's almost certainly going to be reinvested to buy more SOL. The goal will be to increase the amount of SOL backing each share of HSDT stock.
Okay. Which also fundamentally changes how we need to think about return on invested capital, ROIC.
Totally. Historically, Helius had this abysmal ROIC, deeply negative 344%, just reflecting profound inefficiency now. Traditional ROIC as a metric becomes pretty much irrelevant. The new key performance indicator, the main thing to watch, is essentially the return on the SOL treasury. That's going to be almost entirely correlated with how the price of the SOL token performs, plus whatever yield they get from staking. Management skill won't be measured by generating operating profits anymore. It'll be measured by how efficiently they acquire SOL and how effectively they manage that treasury.
All right, let's move into Chapter 3. Financial analysis, and this is where we'll see some truly stark contrasts. Let's start with the key metrics review. Before the announcement, Helius was a tiny microcap, market cap around $8.1 million.
Peanuts, really.
Exactly. Then the news hits, the stock pops, closes at $18.27, and the market cap jumps to about $19.7 million.
Yeah.
Still, a tiny fraction of the $500 million being injected into it.
And those revenue trends we touched on earlier, they just scream failure for the old business model. Between 2020 and 2024, revenue was either falling or stagnant. It ended 2024 just $520,000. And for the trailing 12 months leading up to the pivot, only $295,000. It was a persistent, undeniable decline, just unsustainable.
And the profit margins were, well, you call them catastrophic. Gross margin, negative 89.2%. Operating margin and net profit margin, both negative 7,215%.
Yeah.
These aren't just bad numbers. They show a business that was literally hemorrhaging cash at every single level. No feasible path to profitability in sight.
And it's the same story with free cash flow generation, just a long history of significant negative cash flow. The company never, not once, achieved a single year of positive cash flow from its operations, which is why they constantly had to go back to the market for more equity, diluting existing shareholders just to keep the lights on.
Okay, so that leads us to financial stability. Fragility to fortress, with a catch. Before the pivot, earnings consistency really just meant loss consistency. Always negative EPS, never profitable. Their debt-to-equity ratio looked low, but that wasn't strength. It was because they couldn't really borrow money traditionally. They relied on equity raises.
Right.
And the current ratio might have looked okay on paper sometimes, but it just reflected temporary cash infusions from those raises, not actual operational health.
But now, look at the balance sheet transformation post-PIPE. It's night and day. It's dramatic. Cash and short-term investments go from about $6 million to roughly $506 million.
Wow.
Total assets jump from under $8 million to about $508 million. And total equity soars from around $6 million to roughly $506 million.
Yeah.
So they go from being financially fragile, near the brink, to having what looks like a fortress-like balance sheet. That's the upside.
Yeah.
But there's a big catch, isn't there?
There's a huge catch. This newfound stability is entirely conditional. All that cash, that $506 million, it's earmarked. It's going to be converted into SOL, a highly volatile cryptocurrency. So effectively, they're swapping the near-term risk of running out of money and solvency risk for long-term market risk tied directly to the crypto markets. It's a massive transfer of risk, not an elimination of it.
Which means when we talk about valuation analysis, a new paradigm is needed. The old ways don't work.
Exactly. Traditional metrics, forget about them. Price to earnings is mathematically meaningless. They never had earnings. A discounted cash flow, a DCF model, that's not valid anymore either. Their value isn't coming from future cash flows generated by operations. It's coming from the assets they hold.
So how do you value the new Helius? What's the framework?
The most appropriate way to think about it is based on its net asset value, or NAV. It's pretty simple conceptually. You take the current market value of all the SOL tokens they hold, subtract any liabilities the company has, and then divide that by the number of shares outstanding. That gives you the NAV per share. The actual stock price will then trade either at a premium to that NAV or maybe a discount, depending on how the market feels about the management, the strategy, the risks, etc.
So for traditional analysts, this must feel like the ground shifted completely beneath their feet. The old tools just don't apply.
Right. Now, just for, educational purposes, you could theoretically try to build a DCF model. You could base it on that potential SOL staking yield, say 7% annually, and then subtract the corporate expenses of running HSDT. But, and this is a huge but, you'd need to use an incredibly high discount rate, like 25%, 30%, maybe even higher, because of the immense risks involved, the extreme volatility of SOL, the huge regulatory uncertainty around crypto, the technological risks of the Solana network itself. So the bottom line is, any single value you might get from that kind of DCF model would be highly speculative and unreliable. It's just not the right tool for this job. NAV is the way to think about it.
Okay, that covers the fundamentals of the transformation. Let's move into part 2, market dynamics and the path forward. And we'll kick off with chapter 4, market sentiment. Because, wow, the market's view of Helius was just violently altered on September 15th.
Yeah, violently altered is a good way to put it. Before the announcement, analysts saw HSDT purely as this high-risk speculative medical device play. There were 5 analysts covering it. They actually had a strong buy rating on average, with a price target around $12.80. That was based entirely on the potential of the PONAS device.
Which is now irrelevant.
Completely obsolete. The stock price blew past that $12.80 target in a single pre-market trading session. And what that created immediately was an information vacuum. Wall Street analysts tend to be siloed by industry. It's going to take them significant time to reevaluate, maybe even figure out who should cover a company that just switched entire industries overnight.
And the recent news impact and general media tone.
Yeah.
You mentioned explosive earlier.
Which, oh yeah, immediate and explosive. The news of the $500 million funding, the pivot to a Solana Treasury, it just triggered this massive buying frenzy. The stock surged over 250% in pre-market trading, briefly hit $25 a share. And the media tone, it shifted almost instantly to this kind of meme-like sensation. It attracted momentum traders, crypto enthusiasts. The volume went through the roof. Trading even had to be halted temporarily because the volatility was just too extreme.
So the market indicators are also showing a massive shift, right? What about short interest?
Right. Before the announcement, short interest was tiny, minimal, about 1.42% of the float. Basically, nobody was paying much attention or betting against it significantly. But now, this radical pivot, it's highly likely, as the sources say, to attract a completely new, probably much more aggressive group of short sellers. People betting against Solana or against this specific corporate structure. It really sets the stage for HSDT to become a potential battleground stock. bulls versus bears in a big way.
And the price compared to its moving averages.
Well, that closing price of $18.27 is just dramatically above its key moving averages. The 50-day simple moving average SMA was around $7.76. The 200-day SMA was about $6.47. Those averages help smooth out price action to see the trend. Being so far above them like this, it signals a massive and violent breakout. It indicates the market is fundamentally re-rating the stock based on this new information. It's not just noise.
Okay, let's look inside the company now. Chapter 5. Ownership structure. Because the list of who owns Helius has been totally rewritten.
It's completely remade, yeah. Before this pivot, institutional ownership was, well, practically non-existent. The data showed only 15 institutions holding a tiny number of shares, like 17,000 total. That's totally typical for a neglected, struggling microcap stock.
But after the PIPE deal, who are the key new institutional players?
It's a who's who of prominent crypto-native venture capital firms and investors. It's a really formidable list. You've got Pantera Capital and Summer Capital leading it, of course, but also names like Big Brain Holdings, Avenir, Sinohope, FalconX, Arrington Capital, Animoca Brands, Aspen Digital, Borderless, Laser Digital, Hashkey Capital, Republic Digital. Having all these players involved is a massive vote of confidence in the new strategy. It provides significant strategic validation from within the crypto industry itself.
And what about insiders? Legacy management versus the new team.
Legacy management. No significant recent open market buys or sells reported. Pretty quiet. But crucially, the new structure ensures that the new leadership has immense skin in the game. Joseph Chi, through Summer Capital and Pantera Capital, they led the PIPE investment. Their financial success is now directly, massively tied to HSDT's new mission. That's very strong alignment with shareholders.
So what does this mean for ownership concentration overall?
Well, post-pivot, ownership is going to be highly concentrated among these new PIPE investors, this consortium of crypto VCs and institutions. On the one hand, that can provide stability and a clear strategic focus. They're all aligned on the mission, but it's a double-edged sword. Decisions made by this relatively small group will have an outsized impact on the company's direction. And if any of these large holders decide to sell down the road, it could create significant downward pressure on the stock price. Concentration risk.
All right, that brings us to the crux of it for many investors. Chapter 6, Risk Assessment. This transformation creates a whole new set of risks and rewards. Let's use the SWOT analysis framework. Strengths first.
Okay, strengths. Number one is clearly the massive capitalization. Over $500 million in fresh cash for the new strategy. That's huge. Second, expert management and backers. You've got Joseph Chi's finance background, Pantera's crypto expertise and credibility. That's a powerful combination. Third, potential first mover advantage. It's arguably the largest, most prominent, publicly traded way to get pure Solana exposure on a major U.S. exchange right now.
Okay.
And fourth, that inherent yield generation. The ability to stake the SOL holdings for that native 7% yield, that provides a potential non-dilutive income stream.
Right, now the weaknesses.
Weaknesses, big one. Zero operating history for this new business model. It's entirely unproven in the specific structure. There's still some legacy baggage.
Yeah.
The company still carries the name and history of a failed medical device firm. Could cause market confusion, maybe unknown liabilities lurking. Then there's extreme asset concentration. The company's value is almost entirely dependent on one single highly volatile asset, SOL. Very little diversification. And finally, a deep dependence on external factors. Success is overwhelmingly tied to the price of SOL and the overall health of the Solana ecosystem, things largely outside management's direct control.
Okay, let's look at the opportunities now.
Opportunities are significant too. First, obviously, the growth of the Solana ecosystem. HSDT is essentially a direct leveraged bet on Solana continuing to grow its role in DeFi, NFTs, payments, etc. Second, it can act as a crucial bridge between TradFi and DeFi. It offers traditional investors, maybe institutions, a way to get SOL exposure without dealing directly with crypto exchanges or self-custody.
That's a big one.
Yeah. Third, there's potential for accretive capital formation. If HSDT trades at a premium to its NAV, they could potentially issue new shares and use the proceeds to buy even more SOL, increasing the SOL per share for existing holders. And fourth, related to the bridge idea, is institutional adoption. Being a regulated NASDAQ-listed entity could attract institutional capital that's currently prohibited from investing directly in cryptocurrencies.
But then there are the threats, and these seem pretty substantial.
They are. Threat number one is just extreme price volatility. SOL is known for massive price swings. A prolonged crypto bear market could be absolutely devastating for HSDT's value. Second, regulatory risk. This is huge for all of crypto. The landscape is uncertain. If SOL were classified as a security or if regulations restricted staking, that could severely impact the entire business model.
Right.
Third, technological and security risk. The Solana network itself has had outages and bugs. There's always the risk of security exploits. Plus, how Helius custodies its SOL presents counterparty risk who's holding it for them. And finally, macroeconomic headwinds. A broader risk-off environment may be driven by high inflation, rising interest rates, geopolitical stuff like trade tariffs could really dampen investor appetite for speculative assets like crypto, triggering a flight to safety and hurting HSDT.
Let's quickly touch on that macro piece, the impact of key macroeconomic and geopolitical factors.
Yeah.
Inflation and interest rates seem key here.
Absolutely critical. The performance of speculative assets like cryptocurrencies is highly sensitive to interest rate changes. Rising rates generally make non-yielding or highly volatile assets less attractive compared to safer options like bonds. That's a major headwind for SOL's price and therefore HSDT's valuation.
And geopolitical factors, like those trade tariffs mentioned in the sources.
Yeah, things like major trade tariffs or other events that increase global economic uncertainty. They don't directly impact Solana's code or network operations, but they can absolutely trigger a flight to safety in the financial markets overall. And when that happens, investors tend to sell their riskiest, most speculative holdings first. That category definitely includes cryptocurrencies and crypto-related stocks like HSDT. So while it's an indirect impact, it's a significant market risk factor driven by geopolitics.
Okay, we have covered a tremendous amount of ground here, from a failing medtech to a crypto treasury. Let's try to bring it all together in Chapter 7. Conclusion. Maybe we can synthesize our findings into those two opposing narratives, the bull case and the bear case for HSDT now.
Okay, the bull case. The bulls will look at HSDT and see an exceptionally well-capitalized company, thanks to that $500 million plus from very sophisticated digital asset investors. They'll see it's led by an elite new management team, bringing deep expertise from both traditional finance and crypto. That's rare and valuable. They'll argue the strategy a publicly traded crypto treasury follows a playbook already proven successful by others, like MicroStrategy with Bitcoin. And crucially, they'll point to SLL's native staking yield as unique advantage, a growth flywheel providing income beyond just price appreciation. So, the bull cases. HSDT offers a unique, potentially leveraged, professionally managed way for traditional investors to get exposure to the Solana ecosystem.
All right, that's the bull view. Now the bear case.
The bear case sees this whole thing very differently. They view the pivot as a desperate Hail Mary pass from a company that had already failed spectacularly in its original mission. They'll emphasize that this new business model is entirely unproven, especially in this specific structure for Solana, and it's wholly dependent on a single cryptocurrency, SOL, which is notoriously volatile. So shareholders are exposed not just to the wild swings of the crypto market, but also to corporate execution risks, significant regulatory risks, and those technological security risks we discussed. And importantly, there's no underlying profitable operating business to provide any kind of valuation floor. If the crypto market tanks or if Solana falters, HSDT's balance sheet and its stock price could face catastrophic losses. It's a pure bet on SOL.
So let's quickly reiterate the valuation summary. How should people think about valuing HSDT?
Yeah, just to hammer it home, forget traditional metrics like PE ratios or operational DCF models. They just don't apply here. The intrinsic value, the fundamental value, is best estimated by its net asset value, NAV. That's the market value of the SOL they hold, minus the company's liabilities. The stock price will then fluctuate around that NAV, trading at a premium or a discount based on market sentiment and perceived risks or opportunities. Any attempt to value it based purely on staking yields is, as we said, highly speculative and unreliable. NAV is the key.
Okay, so for our concluding outlook, Helius Medical Technologies has undergone one of the most dramatic corporate transformations imaginable. From a struggling neurotechnology firm on life support to suddenly becoming a major player mining value on the digital frontier, specifically on the Solana blockchain. That closing share price of $18.27 certainly reflects a huge amount of initial market enthusiasm for this incredibly bold new direction. But its future, it's no longer tied to clinical trial results or FDA approvals. It's now completely lashed to the volatile, unpredictable, but also potentially revolutionary trajectory of the cryptocurrency market, and Solana in particular.
Exactly. Whether that $18.27 price or wherever it trades represents a sound investment or just a speculative bubble, well, that depends entirely on Solana's future success and, crucially, on the ability of this new, highly credentialed team to navigate these completely uncharted waters. It's a fascinating high-stakes story to watch.
And just a reminder, this analysis was generated by an AI system for educational purposes only. It should absolutely not be considered financial advice. Please always conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions. If you found this deep dive fascinating and maybe a little mind-bending, make sure to like this video and subscribe to the Stock Analytics AI YouTube channel. Remember, our members, it's just €4.99 a month, get priority deep dives on specific tickers, especially from the S&P 500. We're planning to cover all of them over the next few months, and members get exclusive priority access. You can add your own stock suggestions in the comments below. And hey, if you just want a one-off deep dive on a stock you're interested in, drop us a super thanks. We appreciate the support. Thanks for tuning in to the deep dive.